Well, it's great to be here today. I was an adjunct professor here many years ago when the NYU Business School was downtown. I'm glad that you're up midtown or downtown now still, but not downtown. This is a lot better quarters than what I experienced a couple of decades ago. My remarks today are going to focus on two areas. First, what's the outlook for economic activity, employment, and inflation? In particular, what are the areas of vulnerability that we should be most concerned about? And second, what does this outlook imply for monetary policy? As always, what I have to say will reflect my own views and opinions, not necessarily those of the Federal Open Market Committee or the Federal Reserve System. In my talk, I'll argue that the economic outlook has improved considerably. Despite this, though, we are still very far away from achieving our dual mandate of maximum sustainable employment and price stability. Faster progress towards these objectives would be very welcome and need not require an early change in the stance of monetary policy. However, I'll also focus on some issues with respect to inflation that I think bear careful monitoring. In particular, we need to keep a close watch on how households and businesses respond to commodity price pressures. The key issue here is whether the rise in commodity prices will unduly push up inflation expectations. Inflation expectations are well anchored today, and we intend to keep things that way. But a sustained rise in medium-term inflation expectations would represent a threat to our price stability mandate and would not be tolerated. Turning first to the economic outlook, the situation looks considerably brighter today than it did 6 months ago. On the activity side, a wide range of indicators show a broadening and strengthening of demand and production. For example, on the demand side, real personal consumption expenditures rose at a 4.1% annual rate during the fourth quarter. This is nearly double the rate during the first 3 quarters of 2010. Orders in production are following suit. For example, the Institute of Supply Management index for new orders climbed to 67.8 in January. That's the highest level since January 2004. The revival in activity, in turn, has been accompanied by improving confidence, both for consumers and business. For example, the University of Michigan Consumer Sentiment Index rose to 77.5 in February. That's up more than 8 points from where it was 6 months earlier. In this respect, the 2.8% annualized rise in real GDP that we saw last quarter may understate the economy's forward momentum. That is because growth in the quarter was held back by a sharp slowing in the pace of inventory accumulation. The revival in demand, production, and confidence strongly suggests that we're much closer to establishing a virtuous circle in which rising demand generates more rapid income and employment growth, which in turn bolsters confidence and leads to further increases in spending. The only missing piece of the puzzle is the absence of strong payroll employment growth. We'll need to see sustained strong employment growth in order to be certain that the virtuous circle has become firmly established. With respect to the labor market, there are conflicting signals. On the one hand, the unemployment rate has fallen sharply over the last 2 months, dropping from 9.8% to 9% even. This is the biggest 2-month drop in the unemployment rate since November 1958. On the other hand, payroll employment gains have remained very modest, rising at only 83,000 jobs per month over the last 3 months. Such modest payroll growth is not consistent with a sustained drop in the unemployment rate. The true story here undoubtedly lies somewhere in between, but probably more on the side of the household survey that tracks unemployment. That is because measured payroll employment growth in January was probably temporarily depressed by bad winter weather. Although some of the recent decline in employment is due to a drop in the number of people actively seeking work, the household survey does show a pickup in hiring. And other labor market indicators, such as initial claims and the employment components of the 2 ISM surveys, have also shown improvement recently. This suggests that the weakness in payroll growth is the outlier. Although there is some uncertainty over the timing and speed of the labor market recovery, I do expect that payroll employment growth will increase considerably more rapidly in coming months. We should welcome this. A substantial pickup growth there is needed. Even if we were to see growth of, say, 300,000 jobs per month, we would still have considerable slack in the labor market at the end of 2012. In monitoring employment trends, we also need to recognize that the data are likely to be quite noisy on a month-to-month basis. This is particularly the case during the winter months when weather can play an important role. I recall, for example, the bounce back following the 1996 blizzard in the Northeast, when the February payroll employment gain for that month was originally reported as plus 705,000. It will be important not to overreact to monthly data, but to focus on the underlying trend. So why is the economy finally showing more signs of life? In my view, this improvement reflects three developments. First, households and financial institution balance sheets continue to improve. On the household side, the savings rate, which moved up sharply in 2008 and 2009, now seems to have stabilized in a range of 5 to 6%. Meanwhile, debt service burdens have fallen sharply to levels that prevailed during the mid-1990s. Debt service has been pushed down by a combination of debt repayment, refinancing at lower interest rates, and debt write-offs. Financial institutions have strengthened their balance sheets through retained earnings and by issuing equity. For many larger institutions, a release of loan loss reserves has been important in supporting earnings. Credit availability has improved somewhat as very tight standards start to loosen. As a result, some measures of bank credit are finally beginning to expand again. Second, monetary policy and fiscal policy have provided support to recovery. On the monetary policy side, the unusually low level of short-term rates and the Federal Reserve's large-scale asset purchase program, which we refer to as LSAP, have fostered a sharp improvement in financial market conditions. Since August 2010, for example, when market participants began to anticipate that the Federal Reserve would initiate another LSAP program, U.S. equity prices have risen sharply and credit spreads have narrowed. Long-term interest rates have moved higher after initially declining, but this does not appear troublesome as it primarily reflects the improving economic outlook. On the fiscal side, the economy has been supported by a shift in policy towards near-term accommodation. In particular, the temporary reduction in payroll employment taxes is providing substantial support right now to disposable income and consumption. This could have a particularly strong impact on growth during the first half of this year. Third, growth abroad, especially among emerging market economies, has been strong, and this has led to an increase in the demand for U.S. goods and services. Over the 4 quarters of 2010, for example, real exports rose at over a 9% annual rate, and after a disappointing performance earlier in the year, U.S. net exports surged in the 4th quarter. The firming in economic activity, in short, is due both to a natural healing process following the financial crisis and past and present policy support. In this regard, it's important to emphasize that we did expect growth to strengthen. We provided additional monetary policy stimulus by the asset purchase program in order to help ensure that the recovery would regain momentum. We have been seeking a stronger recovery with more rapid progress to our dual mandate objectives. This is welcome and not a reason to reverse course. We also have to be careful not to be overly optimistic about the growth outlook. The coast is not completely clear. The healing process in the aftermath of the crisis takes time, and there are still several areas of vulnerability. In particular, housing activity remains unusually weak, and home prices have begun to soften again in many parts of the country. State and local government finances remain under stress, and this is likely to lead to further fiscal consolidations and job losses in this sector. This will offset at least a part of the federal fiscal stimulus. And we cannot rule out the possibility of further shocks from abroad, whether in the form of stress in sovereign debt markets or geopolitical events. Higher oil prices, for example, act as a tax on disposable income, and the situation in the Middle East remains uncertain and dynamic. Also, we cannot ignore the risks stemming from the longer-term fiscal challenges that we face in the United States. But in the near term, the most immediate domestic problems seem more likely to recede than become more prevalent. On the housing side, stronger employment growth should lead to increased household formation, which should provide more support to housing demand. And anxieties about the large overhang of unsold homes, represented by the foreclosure pipeline, may overstate the magnitude of the excess supply in housing. Families that have lost their homes through foreclosures are likely to seek new homes as their income permits, even though many may re-enter the housing market as renters rather than as buyers. On the state and local government side, a rising economy should boost sales and income tax revenue and help narrow near-term fiscal shortfalls. Moreover, although we do need to remain ever watchful for signs that low interest rates could foster a buildup of financial excesses or bubbles that might pose a medium-term risk to both full employment and price stability, currently, the risk premium on U.S. financial assets do not appear unduly compressed. On the inflation side of the ledger, there are some signs that core inflation rates are now stabilizing. However, both headline and core inflation remains below levels consistent with the Fed's dual mandate objectives. Most members of the Fed consider this to be 2% or a bit less when measured by the personal consumption expenditures measure. Recent evidence shows that the large amount of slack in the economy has contributed to disinflation over the past couple of years. This can be seen in the steady decline in core inflation that we've seen since the middle of 2008 through the end of last year. For example, core personal consumption expenditure inflation in December was up only 0.7% from a year earlier. That's down from a 2.5% rate in mid-2008. Slack in our economy is still very large, and this will continue to be a factor that acts to dampen price pressures. Nevertheless, there are several reasons why we need to be careful about inflation, even in an environment of ample spare capacity. First, commodity prices have been rising rapidly. This has already increased headline inflation relative to core inflation. And the fact is that the commodity price changes that have already taken place will almost certainly continue to push up the headline inflation rate on a year-over-year basis for several months at least. Second, some of this pressure will feed into core inflation. And third, medium-term inflation expectations have risen recently back to levels consistent with our dual mandate objectives. If medium-term inflation expectations were to move significantly higher from here on a sustained basis, that would pose a risk to inflation and thus would have important implications for monetary policy. With respect to the inflation outlook, I think there are four important questions that deserve attention. First, how much slack is there in the economy? In other words, how fast can the economy grow for how long until the economy is close to full employment? Second, are there speed limit effects in terms of inflation? In other words, could inflation rise because the rate of economic growth was unusually high, even though plenty of slack remained in the economy? Third, given the emergence of economies such as China and India, can commodity price pressures be safely ignored as temporary noise in terms of the long-term inflation outlook, or are these pressures likely to prove persistent? If commodity price pressures persisted, this could undercut one rationale for focusing on core measures of inflation, namely the argument that core measures are better predictors of future headline inflation than today's headline inflation rate. And fourth, what can the Federal Reserve do to ensure that inflation expectations stay well anchored? With respect to the first question, the economy retains a very large amount of slack by virtually all measures. For example, last month the industrial capacity utilization rate was 76.1%. This is nearly 5 points below the long-term average. Similarly, the current unemployment rate of 9% is well above most estimates of the non-accelerating inflation rate of unemployment, what economists refer to as NAIRU. That's the lowest rate of unemployment consistent with sustained price stability. In the pre-crisis period, the NAIRU was estimated to be in the region of about 4.5% to 5%. There are several reasons why the NAIRU may now be higher. First,